Are you a savvy investor trying to seize control, or a first-time buyer getting left in the dust? CoreLogic's head of research, the popular Nick Goodall, is back. What can you learn today to get your financial freedom? Find out next.
Financial freedom faster. Financial freedom faster.
Hit subscribe now and become part of the growing community that wants to get ahead in the uncertain New Zealand property market. CoreLogic's head of research, Nick Goodall, offers deeper insights into real estate trends. Nick, you've got 10 key themes for New Zealand's property market in 2025. So let's start with theme 1.
The first one, in terms of sales values and volumes, is really the fact that we're not seeing great consistency in the amount of transactions that are occurring across the country. For example, Auckland volumes are about 10% up on the same time last year, whereas in Tauranga, they're almost 30% up on the same time last year. So we are seeing some variability there in terms of the amount of transactions occurring. And that also remains true when you look at what's happening with values as well. And we've got a map that we put up, and it does have the whole country, bunch of bubbles, blue ones, which mean values are still falling in the last 12 months, orange or red ones where the values have actually increased in the last 12 months. And all I do is pay attention to some of those patterns that have emerged. Really, the bottom half of the South Island actually saw growth in the last 12 months, so that's to the end of January, whereas parts of the North Island, particularly the lower North Island, Wellington and the border region there, and Auckland and the sort of top half of the North Island, values actually still declined over that 12-month period. Now, if we shorten that to 3 months, you'd see some growth coming back. But from a broader perspective, those more expensive areas have seen values struggle along. Those cheaper areas, particularly the bottom half of the South Island, have seen some growth. Queenstown, the big difference there, it is obviously a unique place all on its own, and we're still seeing some growth in that Queenstown market as you just can't put a price on beauty.
Yeah, Queenstown, I guess similar to Auckland, there's just so much variation. And, you got to, instead of taking the mean, you got to take the median and maybe drop some outliers out. But really, what is going on in Tauranga, I just don't know. 30% change from last year. Maybe there was a bit of anxiety about the change in mayor. Maybe, I don't know. What's going on?
Yeah, well, I think that's probably more what we'd call base effects. There was actually a market that did see a reduction in transactions a year ago, and so it's coming off a low base. And so it's getting back to some level of normality now, as opposed to now suddenly things are taking off and everyone's keen to get back in. But yeah, there's probably something about certainty there. We know it's still a relatively expensive part of the country, so that won't, not attractive to lots of people, but certainly for its markets, some more certainty, an improvement on last year, and things are starting to increase once again.
Great. All right. Well, let's jump into our second key theme, that listings to decline, but slowly and from a high base. Tell us what's going on.
So I think a big part of what the big conversation that we've had in the last, probably, 6 to 12 months has been this conversation about just how many properties are available for sale right now. So it's very much looking at the supply side of things. Lots of properties for sale. Buyers have been relatively restricted, though it has improved recently. And that's just meant that there's been fewer transactions, but lots of properties that are for sale means that there's lots of buyer choice. So for anyone that is actively out there trying to buy a property, there's no desperation. There's heaps of properties to choose from. If they miss out on a property, then they can just wait for another property or go down the road to one that might be for sale down there. And so that's meaning that power still sits with the buyer. They're not paying desperate prices, and that's really what's holding back some of the potential property value growth that might have otherwise occurred if we didn't have so many properties available for sale. The key point, though, the chart on the left-hand side talks about how many properties are available for sale nationwide.
Yeah.
And you can see that, we started the year pretty strong. We've got more properties available for sale today than any time in the last 5 years. And so that is just really showing that high-level figure. We do expect transactions to increase, which will start to eat into that supply as we move throughout the first, 6 months of this year. For anyone that can see the chart, you'll see there is seasonal influence of listings. So you see through winter, total listings does decline. We expect that to continue. And if transactions actually increase like we expect, then that will start to eat into that supply and start to see that fall away from a relatively high base, but it will start to drop away. The chart on the right-hand side shows you some of the regional differences, and that's a big part of our conversation right now when we're out there doing these presentations, is that you're going to see these regional differences. Much like the map before, you're now seeing in somewhere like Gisborne, the number of properties listed for sale today is much, much higher than it was a year ago. And so you might not see the same value growth in somewhere like Gisborne, whereas on the left-hand side of that chart, Northland, and Waikato have fewer properties listed for sale today than they did a year ago. So it's not the same across the board. And so those areas might actually be primed for some better value growth in the short term than those that have lots of properties available for sale too. So it pays to look at those regional differences. The final point you mentioned on that byline was our watching brief on the post-Brightline investor listings. For anyone that saw us present maybe in the first half of next year or maybe from one of our conversations last year, they would have known that we talked about the fact that the Brightline test had shortened, which might actually influence some investors to sell their property sooner than might have otherwise wanted to. So they've not have to wait for their Brightline test period to pass before having to pay a capital gains tax. That's now shortened. They could sell now, no capital gains tax. And while properties were, costing them money, they're having to top up their mortgage every single week or every single month, that would have been a viable option. Now things are starting to improve. We're seeing transactions lift, values start to turn around. Maybe investors aren't so worried about that. They know if they hold longer, they hopefully see some capital growth come back. Mortgage rates are decreasing, and that's meaning their payments are reducing as well. So the finance is starting to improve a little bit. So that expectation we had that investors might list and that would boost listings, that's now starting to reduce, and we don't think that'll have as much of an influence for this year than we did this time last year.
That's great, Nick. If you really want to stay informed on property investing, don't forget to subscribe, hit that button below. Now let's have a look at theme number 3, more deals to first home buyers and investors. And that this market share, of course, has to equal 100%. So it's going to be a rise for them and it's going to be a fall for others. Now we're looking at this share of property purchases per quarter. What's going on?
Yeah, I think a big part of this conversation is around the fact that we know last year was the strongest year on record, calendar year on record for first home buyers as a proportion of all sales transactions that occurred through 2024. Now, the interesting thing is that we actually expect first home buyers to still do relatively well this year. And if you actually looked at a raw number of sales to first home buyers, we might see more sales to first home buyers this year than last year. But because we're expecting investors to come back into the market and movers to start to become more active as well, the share of sales going to first home buyers might actually reduce. And so we do think there's going to be more transactions this year, but it'll go to all three groups. So I think that's just us setting expectations for who might be active this year. And we do think that there's reason for all three types of these buyers to come back into the market. The chart on the right-hand side shows you the gross rental yield over time, and it's slowly increasing as interest rates, which is the mortgage rates on the orange line, as that falls away, the numbers start to stack up for those investors. So we see the market improving for investors. We do think there's some pent-up demand coming from those people that might have otherwise moved in the last 2 years, couldn't or weren't keen to do so. Now they might come back out and be a bit more active this year. So we do see a general market that's more active this year from all types of buyers. And that might just see that first home buyer percentage fall away, which you could see the headlines now. First home buyers share falls away as investors come back into the market, and it's all, doom and gloom. The truth is there might be more first home buyer sales. It's just their share of sales happens to reduce as well. So I suppose that's one thing to watch out for this year when you're looking at which property buyer groups are active throughout the year.
Yeah, and I suppose that with the DTIs and the LVR controls, that's going to limit investors a bit, gives first-home buyers a bit more chance. So let's go on to our fourth key theme, a potential shift to longer-term loans again. And I saw that it was very interesting to see the difference percentage share of new lending on various terms. And it looked like there was quite a good spread between how people choose to allocate their lending on fixed and floating when they're taking new loans. But the percentage share of existing loans expiry length is just a massive tendency towards fixing for that 1 year or less. And I had my thoughts on this, but let's hear yours first.
Yeah, I mean, this is your bread and butter, right? This is what you guys are talking to clients about every single day. I think the key thing we're trying to point out here is that, yes, for those people that took new lending over the last few months, there's been that massive drift towards floating in November while they were waiting for that official cash rate decision from the Reserve Bank at the end of November. But after that decision, people then pushed back to that 6-month period because they didn't want to float for too long. They had a pretty good idea about where mortgage rates were at. So they jumped back to that 6-month rate in general. Also some 12-month rate that was still pretty common as well. But this is a share of new lending. So it only actually looks at when new lending is done for a new home purchase or a top-up of a mortgage or when you switch banks. So it doesn't actually include anyone that refixed. If you just stayed at the same bank and refixed, that's not included in that data. what's really important then is that chart on the right-hand side, which shows of all mortgages that are out there today, how long have they got on their loan term? And what this is really important for is understanding how much, or what's their term going to be in the future, and when is their fixed rate coming up? And then if you had one other chart, if I had a third chart here, it would be looking at the average rate of all mortgages and the new rate they'd probably be moving to. So right now, the average rate across all mortgages is higher than what the rate of the 1 or 2 or 5 year rate is going to be. What that tells us is that for many people, they're going to fix in the next 12 months, of which you can see there over 71% of people are in that position right now. They'll be moving to a lower rate. What does that mean? That means your mortgage payments are going to reduce. That means more money in your pocket, more disposable income, and you can get out there and start spending again. That's really important when it comes to Reserve Bank decisions and their expectation about what's going to happen in our economy. I know there's a slide later on about what's happening in the economy and our expectations for GDP growth, but this is an important one to remember when we come to talk about our expectations for the economy later on this year.
That's great. Yeah, well, I mean, my thoughts on this new lending versus existing lending is there's been such a huge shift in demand for people wanting to use mortgage advisors in New Zealand. You see in Australia, UK, other places around the world, 60, 70, 80, 90% of people using mortgage advisors. And in the last 10 years, there's been that shift from, say, 40% of people using an advisor to now 70, 80% of people starting to use mortgage advisors. And what you'll find is when you're taking new lending and you're getting advice from a mortgage advisor, you're more likely to spread your loan terms and not trying to bet on the market of what's going on with interest rates. You're getting advice. Where this existing loan book, I'd say there's probably a lot of people fixing themselves on apps, not getting advice through that process, and then you're getting a bias towards that 1 year rate. So it's just a reminder, like if you're interested in mortgages and long-term thinking, subscribing to the channel is going to keep delivering you more mortgage-related content. So let's jump into number 5 key theme: debt-to-income ratio limits are starting to bite. Now, what's going on with the DTIs and why?
Yeah, look, you touched on it before, right? The debt-to-income restrictions, which limit how much a borrower can borrow compared to their income, have been in place now since the middle of last year, but they haven't really had any effect because higher interest rates limited how much you can borrow anyway. Your borrowing capacity is reduced by those higher interest rates. As interest rates fall, technically, you can start to borrow more money, and that's when you're going to start to push into these limits, which say that, for first-home buyers or owner-occupiers, you can't borrow more than 6 times your income. For investors, you can't borrow more than 7 times your income. Now, there are some speed limits within this. So actually, 20% of all lending by the banks can be done outside those limits. Right now, less than 5% is being done. So there's a massive amount of allowance there for the banks to start lending outside of those limits. They're nowhere near it right now, but they will come to it with lower interest rates. Off the back of the official cash rate decision and forecast from the Reserve Bank last week, we do expect further cuts to the official cash rate that will flow through to those mortgage rates. That will mean people will start to have their borrowing capacity to borrow more than 6 times their income for an occupier, for example. Then the DTIs come in. And that's just going to start to make them consider, am I allowed to get this? In some areas, it'll be more likely than others, more expensive areas. Those are the areas that might start to use those limits up, the 20% allowance. But for investors in particular, it's going to become a big part of the conversation because ultimately, and the Reserve Bank did some analysis on this, they said that the DTIs will start to restrict how many properties an investor can own and how quickly they can accumulate another investment property. And the main reason for that is it's very hard to earn income at the same rate of the debt that you'd be required to be taking on to be active in the New Zealand property market. So it will likely start to affect investors more so than first home buyers and other owner-occupiers who only have that one property. But for anyone with more than one, they're going to start to restrict with their levels of activity. And there's one more thing to note here is we do wonder, because there's actually new builds and new construction set outside the debt-to-income restrictions as well as the loan-to-value ratio rules, we might start to see people consider going towards new builds rather than existing properties because of these restrictions, which in general is probably a good thing because we need to start to see that new build and new construction space lift up again, as it has declined quite considerably since the peak of consent sort of was up around 51,000 new consents per year a couple of years ago. So some interesting things to watch for because it will start to influence the buyer types and also the types of property that people are looking to build and buy in the next year or so.
Yeah, I mean, you can understand that first principles logic, but are the consequences of these types of things going to be what they intended to be, or are we going to see more negative long-term effects from it? Time will tell. Let's have run into this next key theme of affordability to remain a lingering issue.
Yeah, so carrying on from the theme with the DTIs, I suppose the fact that it's going to restrict how much activity comes from there, we think it should mean that affordability doesn't run away. We don't see value growth like we have in the past. So affordability doesn't take off like it'll get worse in the same rate that it has in the past. What we show here is our 4 measures of affordability in a couple of charts. The one that we're really paying attention to is the black line, the left-hand chart, if we do have a visual there, which shows the proportion of income required to service an 80% LVR mortgage. And what you can see there is in the last 2 years, it's hardly really improved, because even though values of property has declined, interest rates increasing have meant that it's still really hard to service a mortgage. Now, in the latest quarter of data, and actually we're going to add one more quarter to this, we'll release an update on this affordability report, which will be put out for free, by the way. That'll come out next month. When we see that, there's actually 2 months of improvement of affordability. But the one thing I do still point out is that black line, while it has improved in the last 2 years, it still is above the long-term average for the proportion of income that's typically required to pay a mortgage off in the last sort of 2 decades. And so it is still relatively stretched. The amount of income required to service a mortgage today is still more difficult than most years in the last 20 years. And that will just contain the amount of demand which does come back into the market as interest rates fall away. So we do see things improving, and that sees demand lift and sees, competition for properties increase and prices increase off the back of that. But maybe it's a bit more constrained than when it has been, or what could have happened if prices weren't so high and interest rates were still, in that sort of mid-range period, I suppose. And that's on the last point as well, that rental affordability, that is something that's really still quite stretched right now. The only line which is still increasing is the grey line on the right-hand chart. That shows the proportion of income required to pay rent now compared to the last decade. Still quite difficult. Rents are still increasing as incomes are, and so it's still stretching those renters, the affordability of renters, and that can impact their ability to save a deposit as well, to become a first home buyer if they so desire as well. So that might just slow down that activity of first home buyers as well. So I think it's just one thing to note. Affordability still sits across everything, and it will contain the level of true demand which comes forward because they can't afford to get that mortgage.
Yeah, I think it's often forgotten how expensive it is to own a property. and that certainly in the last 5 years, paying a mortgage is a lot more expensive than paying rent. And it really is concerning, I guess, of how much income people have to spend on their rental payments, and getting them out of that rut is difficult. What is the magic solution, I guess, is average incomes in New Zealand really have to go up, and that's a bigger problem, really.
Yeah, and that's a broader situation for our economy, for our labour market. We need to be more productive too, because productivity actually improves our income on an hours worked basis. So then you can do more things if you want more income, right? If you get some time back. So yeah, there's a pretty big, broad discussion there, which I know that plenty of economists have got opinions on, and the government are looking into pretty strongly as well. But you're right. The best thing is to see incomes grow, maybe not see the same price growth and values of properties, and allow that affordability to catch up a little bit, which then starts to boost the broader economy off the back of that as well.
A reminder, if you're determined to outsmart every other New Zealand property investor, smash that subscribe button now and join our elite circle of market trailblazers ready to dominate the game. Now let's go into theme number 7, subdued rents for the foreseeable future. Now, what is going on is very low yields for investors by the looks of it.
Yeah, that's right. I think rents have been slowing down. So rents are still increasing, but the growth rate has slowed down. And that's really because we've seen an increase in rental supply. There's more properties available for rent. Demand is still growing, but it's growing at a slower rate as well. So you got to remember, these things are still increasing, but the rate of increase has slowed down. So things have improved from an investor's perspective in terms of the rent you'll be getting previous to, say, 6 months ago or a year ago, but it's not increasing at the same rate it was a couple of years ago. And when you look at some of the figures around rental growth rates, they've been upwards of 6 or 7% per annum for a while there. They're now reducing in their rate of growth, closer to the longer term average of sort of 3 or 4%. So still increasing, but in terms of covering cost, it's still pretty tight for any landlord trying to figure out how they're going to get rents to cover all the costs they've got themselves. So that's just one thing to watch, and that rate of growth has been declining. From a demand perspective for rental properties, as I said, supply has increased. Demand is still increasing, but the rate of growth, once again, is slowing down. And this is really when we try and look at it, measuring it by migration. How many people are moving to the country, minus those that are leaving the country? It is still net positive, so there's more people moving here than leaving, but the rate of growth has slowed down. We were upwards of 120, 130,000 net new people living in New Zealand a couple of years ago. Now it's back around under 30,000. So, there's just not that same hyper level of demand for rental properties as we've seen in the past. And so once again, there's just less reason to think that rental growth is going to take off because there's so much demand. Supply might be reduced, and then you see rental growth take off the back of that, especially if incomes are increasing as well. So it's just, again, setting probably more of a longer term expectation around rental growth, that it's probably likely to settle in that long-term average of 3% rather than something we've seen in the past at that 5 or 6% rate, which supports that yield for those investors, which, as you say, it's not great. It's improved, but it's not great compared to maybe things we saw a decade or two ago.
Yeah, and I know here that you're saying that the history shows tenants' affordability matters more than landlords' costs. And, despite how much investors would like to be able to pass on the cost, they can't always do that, right?
That's exactly it. There's plenty of data and studies out there that show that rental costs are much more in line with tenants' income than what it costs to own that property. So whether the property costs more because they can't write off depreciation, or they've got things like capital gains taxes, or interest rates go up, the truth is you can't really pass on those costs to the tenant. You generally charge what they can afford, and that's much more consistent over time. Now, there are big tweaks here and there, but the long-term data does tell us that it's more about the tenant income than it is about the landlord costs that dictate where that goes to in the future.
Yeah, that's why it's so important to buy well. So with the bonds lodged dropping significantly away from these peaks, is this because people are staying in properties longer and there's less bond lodgements? What's going on?
Yeah, that's actually the growth in the dollar value of those bonds that are lodged with the Ministry of Building, Innovation and Employment. And so what that's really telling us is that's saying of all properties that are rented today, what's the median rent change?
Yeah.
And it's not as fast moving as, say, the Stats New Zealand CPI measure, which is only looking at new rentals which have gone to market. And so really what that's showing is what are new properties that are being rented, or not new properties that are newly rented or just recently rented over time. How's that changing compared to the whole stock of all properties where a bond has been lodged on that property? And one thing you can see there is that the orange line, the Stats New Zealand measure, is a bit more reactive to recent market change, and it does drop and increase a bit more than the overall one, which can be a bit more slow moving.
Okay, great. So let's go on to theme number 8, construction sector to have a better year. Flatter costs should also entice some households back. So there's new dwellings consented and forecast. What's going on there?
Yeah, so this is our quick look at the construction industry. I think it is a key theme. We've heard lots about property prices in general falling, but I think the thing for us is that you're always seeing these headlines about a property development company going into liquidation. And there is this concern about, can we keep building the amount of properties we need to support our population growth? Are we going to run the risk of having an undersupply of properties because we're not building anymore? And we're well down on our consented peaks. I think I touched on it earlier. 51,000 properties were consented at its absolute peak for 1 year. That's now dropped to around about 30,000. Well, we actually think 30 to 35,000 is probably a more sustainable level where we should be building consistently between 30 and 35,000 new dwellings per year, every year for a long period of time, because we do have strong population forecasts, and we've had strong population growth in the past, which we haven't really kept up with in terms of housing those people. So there's some long-term context here that's required. When we look back at the global financial crisis, which did hit the construction sector really badly, consents dropped to between 10 and 13,000 per year. So we're well above that low of the market, and it looks like consents may be getting to a trough now. So we might see some growth come back. Anecdotally, we've heard a bit more positivity in the construction industry. We've touched on some of the reasons why people might shift back to constructing new as well. Affordability is starting to improve, building new compared to existing. You can get outside the lending restrictions, both loan to value ratio rules and debt to income, to go into the new build. So we expect that to push some demand there as well. And as your last point was, in terms of the cost to build, it's still increasing. Once again, it doesn't really go backwards. It's still increasing, but the rate of increase has reduced dramatically. So again, we're talking about growth in construction costs increasing at around about a rate of 3 or 4% annually, down from what was upwards of sort of 10% annually. So things are starting to improve from that perspective too. And so, for the value you get from building new compared to buying an existing property, which might require some work, the value conversation is going to come back into it for people too. So again, we're not saying, there still could be some time of decline. There still could be some uncertainty for building new and people going, am I really going to build a new property when it's not finished for 18 months? What's my income in 18 months? What's interest rates doing in that time? There's still some uncertainty, which might keep some people a bit cautious from it. But things are definitely better today as interest rates fall, as job certainty starts to increase than they were, say, 12 to 18 months ago when there was much more uncertainty in that market. So maybe a little bit more of a decline in the construction industry before things start to improve maybe in the second half of this year and certainly into 2026 as well.
Yeah, it's good to see construction companies really having to compete for the work now, and instead of having to chase builders to quote, now these guys are it's swung back
Coming
around.
up for you.
Yeah. A reminder, ready to claim your competitive edge in New Zealand real estate? Hit that subscribe button and tap into exclusive insights that'll leave your rivals eating dust. So key theme number 9 is the economy to grow again and unemployment to peak and fall. So this is really about GDP and the unemployment rate. We're expecting things to get better.
Yeah, and I think there's probably a little bit of, cautious optimism, I think, here, not just from ourselves, but from the government themselves. I think when you talk to, whether it's the private economists too, they do have forecasted GDP growth, which essentially means our economy expanding, more businesses doing better this year than they did last year. But as I touched on earlier, the main reason for that is because of interest rates falling. And the Reserve Bank say it themselves. They know the economy needs support, inflation is under control, so they can reduce the official cash rate, reduce mortgage interest rates, starts to put more money in our pockets. We go out there and spend more, so businesses do better, they start to invest in the future. And it's a bit of a cycle there, right, as to how that all flows through, the money flowing through from our pockets into those businesses. And when you look into the detail of any GDP forecast, there's not really much in there that says, government aren't saying they're going to be spending lots this year. We're not expecting tourism to take off, for example. It's not like the farmers are going to be doing much better this year compared to last year, other than maybe them paying lower interest rates as well. So, I think there's no real major part of the economy that's going to do better this year than the last couple of years. It's really about consumers consuming more. Us householders actually going up there and spending money because we got more money in our pockets from those lower interest rates and lower mortgage payments. So that's the key contributor. And that's part of the reason why we expect the Reserve Bank to continue cutting the official cash rate so that we continue to see these falling mortgage interest rates, falling mortgage payments. And so we start to be out there and spending more and giving that certainty to those businesses. So that's a core part of the recovery here, is the official cash rate falling. And that's why we still expect those cuts to come in the future. Unemployment and the job market's a key part of this as well. As those businesses start to do better, they see better forecast themselves with their own revenue. They know they can hold on to their staff, and so maybe there's going to be less unemployment out there as well. And so, as you said, we do forecast, or many of the economists are out there forecasting unemployment to peak very soon, either this quarter we're in right now or Q2 this year, before the unemployment rate starts to reduce in the second half of this year again. So as businesses get more certainty, start to do better, hold on to their staff, employ more people, that's when we'll start to see that improvement through the labour market as well. So there's a little bit of hopeful optimism, I would say, here as well, but it's based on those forecasts of the official cash rate dropping as well. So there's good reason for that to come through this year. And that, of course, means flowing through to the property market too. When you look at the property market, so much of our economy really is dependent on the property market as well. Not like just, mortgage advisors or real estate agents that benefit when properties turn over, but there's moving companies and there's a number of different industries and economies in New Zealand which rely on property transactions, and we do expect transactions to start to lift as our economy improves. So it's all tied in together.
Okay, well, let's go on to key theme number 10, which this really grabbed me when you talked about it the other day. So some context and long-run thoughts. It's been a prolonged and deep downturn. Future house price growth could also be slower. And there was a couple of key points, if you can run us through them.
Yeah, of course. So the one chart we show here is basically what have property values done since the peak of the market this time around compared to the last time we had a major downturn, which is the global financial crisis that kicked in 2007 and ran for a few years. And the really interesting thing here is the global financial crisis, property values dipped by about 10% in total before slowly increasing back to that peak. And values didn't get back to that peak of 2007 until 5 years later. Now, this time around, the decline in values has actually been greater. So we've seen a greater decline. Now we're a few years later, so we haven't got to that 5-year period yet. But for values to get back to that peak, if it takes 5 years, we're going to see some decent growth. It might even take longer. So that peak of the market this time around was 2021, 2022, end of 21, start of 22. If we see 5 years, it's not going to be until 26, 27 before values make up that decline we've seen and get back to that peak of end of 2021, for example. So just setting expectation that it does take some time for that recovery to play out. And then when we look at that long-term context, I sort of got these 4 icons. And I say, these are the key things which have influenced property prices over the last 4 decades. And so we work through each of these different main factors and then say, what influence could they have in the future? So I'll work through each of those ones. Interest rates, we got a little arrow down with a percentage there. Interest rates have declined dramatically, fundamentally have changed over the last couple of decades. From an average long term of 20-odd%, 50 to 20% for a long period of time, now to a position of around about 5%. Now, that's a significant fall away. They can't fall from 5% to, negative 5% again. They can't fall by that margin again in the future like they have in the past. So that dramatic shift, and that's one thing that led to strong property price growth in the last couple of decades, can't really happen again. We'll see some falls, no doubt. We'll see some increases, of course, as well. But that fundamental shift in interest rates from 20% to 5% can't happen again. So that's unlikely to push prices up in the future as they have in the past. The other one is land availability. Land availability and restriction on land use has been pretty significant in the past, and that has been something that's contributed to long-term house price growth over the last 10, 20, 30, 40 years. Now, we have seen some improvements to the ability to build land and build on land, intensification, encouragement for densification, approved and agreed by both of our major parties in New Zealand. So I do think that land use and land use restriction has changed pretty dramatically in the last couple of, probably years, and certainly in the last 10 years. Auckland Unitary Plan in 2017, that's one of the factors, but also things like medium density residential standards have meant we can build more on less land, and that will also restrict how much property price growth we see in the future compared to the last few decades. The other one is household income growth. So, 10 or 20 or probably 20 or 30 years ago, most households had one income earner. In the last 20 or 30 years, we've moved to this, fundamental shift to income earners per household. What does that do? Almost doubles your income over that period of time. Means you could borrow more, means you could pay more for housing. Now, that can't really happen once again either. Unless we start to move to triple household incomes or more, we can't see that borrowing power increase in the future by as much as we've seen in the past. So the fact that we saw greater incomes and incomes increase so much, so dramatically in a short period of time, that led to part of the house price growth we saw, say, a couple of decades ago. That can't happen again either. And so that will definitely see less house price growth in the future than we've seen in the past. And the last one is government. Government restrictions, government influence as well. We have seen that that's changed over time, and potentially, there's much more discussion now about, do we need to rebalance our tax take in New Zealand away from income tax and how much we tax our income by to something else, capital tax, capital growth tax, wealth tax. Now, I'm not saying those things will happen now or next year or even in the near future, but it would probably make sense that at some stage in the future, we're going to see a shift in the way we tax incomes in New Zealand, not just from the income that we get from our wages, but towards some form of capital and wealth tax as well. When that happens, who knows? But that will also be a key influence on what future value growth looks like compared to the past. And so the way I frame this up right at the end then is to say, if you look back at the last 4 decades and everyone talks about property prices double every 10 years, and I think, the average compounding annual growth rate for property prices in the last 30 or 40 years has been in that 6 to 7% range every year, year on year. all we're saying is we expect, because there's key fundamental contributors to that growth, can't really happen to the same degree in the future than they did over that 4-decade period. Maybe we're in for a longer term reduced capital growth rate than we've seen in the past. And maybe that growth rate longer term looks much more similar to our income growth rate of maybe 3 or 4%. And as our income grows, we can borrow more, we pay more at property prices, and that would be a much more likely trend of property price growth than what we've seen in the past around those, 6 to 7, because those fundamental things can't really happen again. Now, I'm sure people have said that in the past. 10 years ago, they would have said it, and then it happened again anyway. So I'm sure there'll be something in the future which will change, whether it's a fundamental shift to our labour market, or I don't know how interest rates work, or incomes change dramatically for one reason or another. Who knows? The use of AI. Something will probably contribute to this being different than our expectation. But if you take a conservative central scenario, 3 or 4% growth in property prices per year looks more likely than the 6 or 7% we've seen in the past. So, we'll see how it all pans out. But that's, if we use our common sense, I think that's where we sit at the moment.
A reminder, don't let your competitors steal the spotlight in New Zealand's property market. Subscribe now and get cutting-edge strategies and insider secrets that guarantee your success. Nick Goodall from CoreLogic, Head of Research. Thanks for joining us today.
Awesome. Thanks so much for having me. Enjoy.
More cash,
Thanks,
passive
man.
income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ